Since most of us just finished our tax filings, I thought it'd be a good time to discuss the tax advantages of owning real estate. The big four in my eyes are passive income, capital gains, depreciation, and the 1031 exchange. Passive income, in regards to real estate, is any money that is earned from business activity that investors do not physically participate in. The most common form of passive income is rental income earned through an investment property. Before 2018, rental property investors could only offset passive taxable income through passive losses. The Tax Cuts and Jobs Act of 2018 allows businesses that earn qualified business income, which includes rental net income, to not pay taxes on 20% of their taxable profit from that business activity. Rental income is not considered earned income, not wages, not self-employment, and it does not reduce Social Security benefit income. Capital gains are the profits that investors make when they sell their real estate property, which includes rental, residential, commercial, or industrial property. They can be taxed as short-term, held 1 year or less, or long-term, properties held over 1 year. Short-term capital gains receive no special tax treatment, but long-term capital gains receive a lower tax rate. Depreciation is one of the strongest benefits of owning real estate. The IRS has assigned a default useful life for real estate, in most cases 27.5 years for residential rental property, or 39 years for commercial rental properties. These assets are assumed to depreciate or decline in value for tax purposes over a straight line from the date of acquisition to years 27.5 or 39. Depreciation is treated as an expense and reduces the amount of taxable income a property earns during any given year. Investors can also identify assets that have a shorter useful life through a process called cost segregation. A professional will evaluate the assets and determine which assets have a shorter useful life than the structure itself. These may include such items as new carpet or a new roof. This cost segregation analysis effectively increases the value of the depreciation tax benefit. This is especially powerful when combined with bonus depreciation. Bonus depreciation allows an investor to accelerate the depreciation for any asset with a useful life of less than 20 years in the first year. Just remember that depreciation and bonus depreciation are not a tax eliminator, but a tax delayer. When the property is sold, the IRS hasn't forgotten about the tax benefits you received along the way. They are waiting to recapture those gains. This is where the last tax benefit of real estate ownership that I want to mention comes into play, the 1031 exchange. Named for Section 1031 of the Internal Revenue Code, a 1031 exchange is a swap of one real estate investment asset for another. While most investors' swaps are taxable as sales, a 1031 exchange will have no tax or limited tax at the time of the exchange. For investors, this means you can roll over gains from one piece of real estate investment to another, avoiding taxes until you actually sell the replacement property. To complete a non-taxable 1031 exchange, the replacement investment or business real property must be equal to or greater than the current investment or business real property. A qualified intermediary should be used to structure the transaction. I would suggest talking with your CPA concerning these tax advantages. If you have any questions for me, please do not hesitate to contact me at 314-296-5324. Thank you.